Disclaimer: this video is for educational purposes only and is not financial, investment, or legal advice. Always do your own research or consult a licensed financial professional before making any investment decisions. Welcome back to Money Mindset. Today we're covering a topic that every investor needs to understand: the safest ETFs for conservative investors. Not everyone wants roller coaster rides in the stock market. Some people prefer stability, predictable returns, and protecting their capital. If that sounds like you, this video is for you. We'll cover bond ETFs, dividend aristocrats, defensive sectors, and low-volatility strategies that can give you long-term growth without the stomach-churning swings of high-risk investing. Let's start with bond ETFs. Bonds are traditionally among the safest investments because they represent debt from governments or corporations with a promise to pay back principal plus interest. ETFs like BND, the Vanguard Total Bond Market ETF, give you exposure to thousands of bonds in a single fund. You're not betting on one company, you're investing in the whole US bond market. Bonds move much slower than stocks, and they often rise when stocks fall, providing stability during market downturns. For ultra-safe short-term options, ETFs like VGSH focus on short-term US government bonds. These move very little, even in turbulent markets, and are ideal for conservative investors seeking preservation of capital. Next, we have dividend aristocrat ETFs. These funds focus on companies that have increased their dividends every year for at least 25 consecutive years. The Nobel ETF is a prime example. Why are dividend aristocrats considered safe? These are mature, financially stable companies that can weather recessions and continue returning cash to shareholders. They may not skyrocket like tech stocks, but they provide consistent income and tend to hold their value better in downturns. Reinvesting dividends from these ETFs can also compound growth over time, even if price appreciation is slow. Moving on to defensive sector ETFs, these invest in industries that people always need, regardless of economic conditions. Think healthcare and consumer staples. Healthcare ETFs like XLV include major pharmaceutical companies, hospitals, and medical device makers. People will always need medicine, treatment, and health products, which makes this sector highly resilient during recessions. Consumer staples. ETFs such as XLP include household goods, food, and essential items. Even if the economy slows down, people still buy groceries, soap, and toothpaste, meaning these companies continue generating revenue. Defensive sector ETFs are slower growing, but their stability protects investors from large swings. Another important type of conservative ETF is the low-volatility ETF like SPLV, which selects the 100 least volatile stocks in the S&P 500. This ETF focuses on stocks with smooth price movements, reducing risk during market turmoil. While you may miss out on some explosive gains, you avoid extreme losses, which is exactly what conservative investors prioritize. Low volatility ETFs can be a core holding in a defensive portfolio, providing steady returns over the long term. Now, let's talk about diversification across conservative ETFs. A truly low-risk portfolio often combines bond ETFs, dividend aristocrats, defensive sectors, and low-volatility ETFs. For example, a mix could include 50% bonds via BND, 20% dividend aristocrats via Nobel, 15% defensive sectors like XLV and XLP, and 15% low-volatility stocks like SPLV. This combination balances income, stability, and modest growth. Diversification helps reduce risk because when one sector dips, another may rise or remain stable. It's also important to remember that safe doesn't mean no risk. Even bond ETFs can lose value if interest rates rise sharply, and defensive stock ETFs can decline in extreme market crashes. The goal is controlled risk, not eliminating risk entirely. Conservative investors succeed by staying disciplined, holding diversified ETFs, and focusing on long-term growth rather than short-term speculation. So, how do you get started with conservative ETFs? Step 1. Define your goals. Are you saving for retirement, preserving wealth, or seeking passive income? Step 2. Determine your risk tolerance. Step 3. Pick ETFs that match both your goals and tolerance. And Step 4. Invest consistently over time. Remember, even safe ETFs benefit from long-term compounding, reinvesting dividends, and avoiding panic selling during market corrections. Finally, here's a simple takeaway. Safe ETFs are not about chasing big returns. They're about peace of mind, stability, and predictable growth. Bonds, dividend aristocrats, defensive sectors, and low-volatility strategies allow investors to build wealth over time without sleepless nights. They're ideal for conservative investors, retirees, or anyone who wants to grow money steadily while minimizing risk. If you found this video helpful, make sure to like, subscribe, comment which ETFs you want us to analyze next, and turn on notifications. We post new videos every single day to help you invest smarter and safer.